Real estate investment presentation, Wraparound Mortgage. Get ready because we're raising the stakes with real estate. Wraparound Mortgage, referencing Investopedia, Julia Kagan. Investopedia being a place you can go to look up investment-related terminology and continue your research from there. The wraparound mortgage can be a complex concept to wrap our heads around. We will go through a more detailed example which can help us to get a better idea of it. But let's go over the general idea of it here. We'll go over some of the terminologies, and then we'll get into that more detailed example. So remember the general scenario that you have if it were not a wraparound, but standard kind of sales process between a buyer and a seller. If you think about the seller, they usually still have financing or a loan out on the property oftentimes. So you got a seller, they've got a loan, the property being then the collateral on the loan. They would like to sell the property, they set the sales price. The buyer then wants to pay the sales price. They typically need a loan in order to do so. They go to the bank, they get a loan in order to get the money to buy the property from the seller, pay the seller. The seller takes that money, turns around and pays the loan that they have still outstanding on the property, and that's kind of the general scenario. A wraparound mortgage then is going to be a form of seller financing where in essence the seller is going to be basically acting kind of like the bank, having that IOU from the lender, and that basically IOU, that note, is going to be wrapping around the existing mortgage which is still going to be in place, so that the seller then is going to get payments from the buyer, and they're still going to have to be paying off the mortgage that was in place before this process took place, before the sale happened. That's kind of the general concept of it. Let's think about it in a bit more detail. So a wraparound mortgage is a type of junior loan. So when we say it's a junior loan, we're saying that first loan that the seller still had out, it's still out there, and therefore it's going to be basically the primary loan in general. The secondary loan or the junior loan then is secondary to it. So the institution with that second loan, if there was a problem, is going to be kind of paid off second if they had to foreclose on the property in general. And that could have consequences kind of, in the event that there's an issue with the property, it could have consequences with the terms that you might negotiate on the second loan and so on. So it wraps around or includes the current note due on the property. So when we say it wraps around, notice the current loan is still outstanding. It's still there from the seller. So the seller then acting as the financing. So they're going to get the financing for the sales price of the property, meaning they're going to be collecting payments that are going to be equivalent to basically the sales price of the property, taking part of those payments and paying off the loan that was still outstanding. And that's what they mean by kind of wrapped around. That second loan is large enough that it's the sales price. The first loan that was still there is still going to be basically paid off with the proceeds from the second loan that is wrapped around it. So the wraparound loan will consist of the balance of the original loan plus the amount to cover the new purchase price for the property. So in essence, they're going to sell the loan. The IOU, in essence, is going to be for the purchase price of the property, and that purchase price is going to be enough, over the amount of the existing loan on the property. The buyer then paying the seller, who is acting like the bank, the seller taking that money and then paying off the existing loan that they still have out with the bank. So these mortgages are a form of secondary financing. So it's a secondary loan, secondary financing, because you have that original loan still out there. The seller of the property receives a secured promissory note, which is a legal IOU detailing the amount due. So the seller, in essence, acting like the bank. So in essence, the buyer is saying, I'm not going to go to the bank and get the loan at the bank. The seller is going to be acting as the bank. So they're going to get their sales price, but they're going to get it in terms of the payment, the loan amount, and then they're going to set up the loan, and they're going to be acting, in essence, like the bank, and then having the property as security on the loan from the buyer to the seller, although the security could be a secondary security. In other words, the primary securities for the original loan that is still outstanding. So the seller then receives the money from the buyer in a similar fashion as the bank would receive it. And again, they take that money, turn around, and pay off the mortgage that they still had on the property, the loan that was still outstanding. So a wraparound mortgage is also known as a wrap loan, overriding mortgage, agreement for sale, a carryback, or an all-inclusive mortgage. So if you see some of these other terminologies, then you have a similar kind of process going on here. So how a wraparound mortgage works. Frequently, wraparound mortgage is a method of refinancing a property or financing the purchase of another property when an existing mortgage cannot be paid off. So if the existing mortgage can't be paid off, or if you're in a situation basically where you're saying that you want to set a certain price, there could be advantages and disadvantages in certain circumstances. So for the seller, if they want to get a certain price on the property and they're willing then to basically finance the property, that might be a way that they can get that price on the property a little bit more easily in that cases, and it might be a little bit easier in some cases for the buyer then to finance the property in that way. So if the buyer couldn't get the financing basically from the bank to get the money for the sales price, that could be another method that can be used. It also can be used as a method that the seller then, they're not going to get the lump sum money up front, but they might get the deal that they want, the purchasing price that they want. They can also get a spread possibly between the interest rates on their current loan, because if they have a good interest rate on the current loan, a low rate, and the current interest rates are higher, then it could work out good for them to finance the loan, basically act as a lender at the higher rate, and then be collecting at the higher rate and paying off and servicing their debt that was locked in basically at the lower rate. It also can be nice to just have the setup to be acting as the financing in that way, so that you get those kind of monthly payments while still being able to negotiate possibly a higher price if it's something that would be beneficial on both sides to the buyer and the seller. Clearly, it's a little bit of a deviation from the standard process, and whenever that's the case, you gotta make sure that you know exactly what's going on with the process, and you set up the situation so it's appropriate for both people involved and be as transparent as possible. So the total amount of the wraparound mortgage includes the previous mortgage unpaid amount plus the additional funds required by the lender. So the borrower makes the larger payments on the new wraparound loan, which the lender will use to pay the original note plus provide themselves a profit margin. So obviously they're gonna act as the bank. Their note is still out there. They still owe the bank. So they're gonna need to get paid from the purchaser of the property, because they're acting as, in essence, the bank for them, and then take that money, turn around and pay it to pay off the mortgage that was still on the property, the loan that's still on the property. So depending on the wording of the loan document, the title may immediately transfer to the new owner, or it may remain with the seller until the satisfaction of the loan. Now, there could be complications with the loan, with the transfer of the property and the original loan being outstanding, because there could be clauses saying, hey, you can't sell the property until you basically take care of this loan, right? So in that event, then you could have a situation where you could set up the situation, in essence, possibly, where the property doesn't actually transfer over until the satisfaction of the original loan or something like that. So you want to make sure that you're in alignment with any kind of clauses with regards to the ability to transfer property with the original mortgage that's in place. So how a wraparound mortgage works continued. Since the wraparound is a junior mortgage, any superior or senior claims will have priority, meaning the seller then is financing the property, and they're acting as, in essence, the bank. They're going to be just like the bank would. They're going to have the property as collateral, so that if the buyer does not pay them, then you have the recourse on the property, hopefully. But it's a secondary recourse, meaning if there was some kind of foreclosure process, then the foreclosure would happen because there was a default on the payments, and then you'd sell the property, but the primary mortgage would get paid first, and then basically the secondary mortgage. So you're kind of second in line on the secondary mortgage, which means you're going to have a little bit more risk, of course, that will be involved. Obviously, if the buyer doesn't pay you as well, you got other complications as well, which could include that you can't pay the mortgage, the second mortgage, and then the dominoes can fall, and that can be a problem as well. So in the event of default, the original mortgage would receive all the proceeds from the liquidation of the property until it is all paid off. So again, if there was a foreclosure process, even though you're kind of using the property as collateral, the proceeds would first pay off the first mortgage and then the second. Now, obviously, if housing prices go up and there's enough equity in the home Hopefully there's enough security to pay off both, but in the event that there's a downturn in the market or something like that, then you're second in line for the pecking order. So wraparound mortgages are a form of seller financing where instead of applying for a conventional bank loan, a buyer will sign a mortgage with the seller. The seller then takes the place of the bank and accepts payments from the new owner of the property. Most seller finance loans will include a spread on the interest rate charged, giving the seller additional profit. So this is one of the reasons this could be if you're in an environment where you have a fixed rate, you're the seller, and you have a fixed rate on the property, and then the rates have gone up in the environment. That means that if you were to service the debt, then you're still paying off your loan at the lower interest rate, and you can charge then the higher interest rate because that's the market interest rate. So you would be receiving money on the loan. So the trade-off would be that you're not getting the money up front, obviously, which you would have in a normal loan, right? If it was normal financing, the buyer would then get a loan and they'd pay you the money up front. You're financing the debt, but one of the benefits on that is it could be a good investment if you can get the larger interest rate on it and you have a spread and you're paying off your loan at a lower rate, and you might be able to negotiate, a higher price due to the fact that you're willing to basically, service the debt in that way. So it could give you some advantages in that way. So, and then on the buyer side of things, of course, if you're short on financing and it's difficult to get financing traditionally or something like that, then if you're in a situation where the interest rates are higher, then it might be the fact that you might be able to get property in that way by doing, setting up a process. And that's in this way. It could be the case where, baby boomers at this point might want to, sell the property and so on at this point in time, and servicing the debt in this way may be a way that they can get the price that they want and get like the steady stream of income, and possibly they've locked in a rate that's fairly low, and if rates go up at this point in time, then they could be in a situation that they could benefit from the spread on the interest rates, and that could be good for both the seller and the buyer to negotiate. That gives room for negotiation. So for example, Mr. Smith owns a house which has a mortgage balance of $50,000 at 4%. So we're going to say the owner, the seller, $50,000. They have a house for $50,000, and the rate is at the 4%. So Mr. Smith sells the home for $80,000. So we're going to say they're going to sell the home for $80,000 to Miss Jones, who obtains a mortgage from either. We're going to say they're going to get the mortgage. I'm going to say from Mr. Smith, right? So now we're going to say instead of Miss Jones going to the bank and getting the $80,000 to pay off the loan, the sales price, and then Mr. Smith taking that $80,000 and paying off the $50,000 loan, which is what would normally happen. Let's imagine that Mr. Smith here is going to finance the debt. So now there's an IOU from Miss Jones for the purchase of the home of $80,000 to Mr. Smith. So now Mr. Smith still has the loan outstanding of the $50,000 at the 4%, and Miss Jones is now owes Mr. Smith the loan of the $80,000 at the 6%. So notice the spread here that Mr. Smith is making, and if there's a period of increasing rates, that's quite likely. They might have locked in the rate over here at the lower rate, so when they make the loan, then they can make the loan at the higher rate, and that could be beneficial because now possibly you get the sales price that you're looking for, $80,000. However, you're not going to get that money in cash. Mr. Smith's not going to get that money in cash. Instead, they're going to finance it and get it over the financing. However, that could be a good investment because they're going to get the current market rate of the 6%, and they're going to pay off their debt at the 4%. Now, obviously, if Mr. Smith needs this money from Miss Jones, the payments, in order to pay off their mortgage debt, then if there's a problem in payments from the buyer, Miss Jones, to Mr. Smith, you have a domino effect of a problem because now the payment's not going over here, and now Mr. Smith's not going to be able to pay off the $50,000 mortgage and so on, and that's obviously one of the risks that can be involved. Obviously, Mr. Smith here also, when they extend the $80,000 mortgage, is going to want to try to have the collateral be in the property but the first mortgage is the $50,000. So if there was a foreclosure on the property, in this case, then the bank would get the $50,000 first before Mr. Smith could recover their funds from the property. So hopefully the property goes up in value, and that's not really a problem, but they're second in line in the pecking order in the event that there's a default. So Miss Jones makes payments to Mr. Smith, who uses those payments to pay his original 4% mortgage. That's kind of the idea. Examples include, so Mr. Smith makes a profit on both the difference between the purchase price and the original owed mortgage on the spread between the two interest rates. So obviously you got the profit of whatever the profit is on the sale of the property, which would be the sales price minus the cost whenever Mr. Smith purchased the property. So you've got the profit that would be there, although you haven't really gotten the money at this point in time, right? You just got an IOU. You're going to get paid the $80,000 over whatever, the 30 years, whatever you set the terms. And you're also going to get the benefit of the spread, the difference between the spread. So if you sold it for interest rate of the 6%, and you're paying off 4%, then you're making the spread, the 2%, on that, that loan amount for the amount that you have to pay off, and you're making the 6% on the amount over and above the $50,000 in this case, which would be the $30,000 as well. So you're making that. So Mr. Smith makes a profit on both the difference between, we said that. So depending on the loan paperwork, the home's ownership may transfer to Miss Jones. So again, you've got that kind of complication with that first loan being out there to make sure that you structure this in such a way that you're not violating any clauses with the original mortgage that was out there, possibly a clause saying you can't transfer the property until you pay off the original loan. So you want to make sure you got that into consideration. However, if she defaults on the mortgage, the lender or a senior claimant may foreclose and reclaim the property. Once again, referencing Investopedia, Wraparound Mortgage by Julia Kagan, reviewed by Brandon Renfro on August 31st, 2021. You could take a look at Investopedia, looking up investment-related terminologies, and take a look as they update things going forward with Investopedia.